Alright, so we begin today financial management 6, and today's lecture is we continue with financial management from Brigham. We continue with financial markets and institutions, which we just simply call financial economics. Financial economics. And financial economics, as I explained in the very first lecture, is the subject and study of the financial system. And the financial system has financial markets, the second piece is financial institutions, and the third piece is financial instruments. The first definition is amazingly simple. Financial market is a market where financial instruments are traded. That's it. So, it's a place where people buy and sell financial instruments. That's all there is to it. Now, we need to say, what is a financial instrument? And financial instrument has two very different, but turned out to be identical definitions. And the first definition is of a claim. A financial instrument is a claim on assets or income of an entity, of a business, of an entity. It could be also government, okay? So it is a claim on asset or income. The other is very actually good proper definition, which is an asset which is someone else's liability. So financial instrument for the buyer is an asset, and we also call it investment, and for the seller, who is an issuer, is an obligation. So every financial instrument, because it is someone else's liability, has also possibly some sort of counterparty risk. Counterparty risk simply means that it is a risk associated with the other side of the contract. So, you have a contract between two parties. It is the risk that the other party in the contract will not perform their duties and their responsibilities. Okay, that's counterparty risk. So, every financial instrument, first is a claim, the second is an asset, which is someone else's liability. So, financial instrument is both an asset and a liability at the same time, okay? And the simplest example that we always like, well, I always like to provide is show you a simple bill. This is both an asset and a liability. It is an asset for me because I own it and I put it in my pocket, and it is a liability of the Central Bank of Taiwan. Central Bank of Taiwan is the issuer, okay, and it is their liability. For me, it's an asset. Now, we can further discuss a little bit financial instruments and say the following. We have the following primary or major financial instruments. And the first major financial instrument is stocks. Stocks representing equity. The second major instrument, we call it type of instrument, is bonds. Representing debt. Bonds have a very special name, and that's how they're usually known. They're simply known as fixed income securities. Fixed income securities. Okay? So, bonds we just called fixed income securities. And now I'm providing yet another explanation from lecture 1. The first is that financial instrument is exactly the same as financial asset. Another very common name is paper asset. Paper asset. And another common name is security. Security. So, security, as I explained now, has two or even more completely different meanings in finance. One meaning here in financial economics is simply that of a financial instrument, okay? Which is pretty much, sometimes actually they would even like to call them financial claims. Financial claim. Financial claim, okay? So all of these is exactly the same thing, which is financial instruments. And the third primary class is currencies. Currency is simply, again, financial instrument issued by the central bank and circulating as money. Okay? So, as long as people use it as money, it represents a currency. Okay? So, these are the three primary financial instruments, okay? And I'll be discussing a lot more in a minute. And now the last piece which we need to discuss is financial institution. And again, very many different definitions, but the simplest one that we had a while ago, it is simply a business which specializes in transferring funds from savers, from those with surplus of funds, to those with deficits of funds. So, you have the concept of saver. And saver is someone with a surplus of funds. They have more funds, more money than they have. And these savers, when they purchase a financial instrument, these savers we call now investors. So, the buyer of a financial instrument is called investor. The seller of a financial instrument is called issuer. So you got a financial institution. The financial institution might be intermediary on the financial market. So you may have here a financial market, and on the other end you have possibly issuers. Now, sometimes they like to call them borrowers, but it's not exactly correct, because here the issuer, when you have borrower, borrower is only of bonds, okay? So, and lending is associated with, so issuers is in general somebody who sells financial instruments in order to raise funds. In other words, they need the funds and they get the funds, okay? And on the other side is the saver who has the funds, gives the funds in exchange for the financial instrument. And the key to the financial instrument is, as in any investor, in any investment, it's return. Okay? That's it. So sometimes these financial instruments are simply called investments. But, and here's another key explanation, not every investment is a financial instrument. Let's provide two key examples, or two key categories. Number one, real estate. Real estate is an investment, but it is not a financial instrument, okay? It's not a financial instrument at all. If you have a house, the house is not necessarily somebody's liability, all right? There is no corporation or central bank or any institution, somebody who issued it. And the other one is simply called commodities. Commodities like gold, silver, oil, rice, wheat, and all of those types of things, which is basically, we call these hard assets. So these are called real assets. Real assets or hard assets. Hard assets. And now we are getting back to one of our maybe first or second lecture. And the first or second lecture was about intrinsic value. Intrinsic value. And now the definition of a real asset and hard asset is asset with intrinsic value. Hard asset is an asset that has intrinsic value. It's got a value of its own. On the other hand, financial instrument is an asset without intrinsic value. Without intrinsic, it's got no intrinsic value. You don't use the money for the paper, okay? You use it because it's a claim on the central bank. You can exchange it for dollars or yen or something else, but for some other reason. Bonds is just a piece of paper, okay? It's a claim. That's why it's called paper. Mistake, I just saw this here. It's not the asset, okay? I just noticed it's a T, asset, okay? A bond is a paper asset. It's just a piece of paper, and it's a claim, okay? The piece of paper itself has no intrinsic value. It's a value only because it has a, we call it, legal claim on the assets or income of the issuer, of the borrower, okay? So, only for that reason, because they have some other assets or business or in some way can satisfy, okay? So, investments all fall in two categories, financial and real. The financials are stock, bond, currencies, real are real estate and commodities, okay? And financial economics focuses on financial assets. We also call them financial instruments, okay? So these five are the same, but this investment is not the same as these five, because investments got two extra categories, okay? So financial instruments, these three. Financial assets, these three. Paper assets, these three. Again, security, the three primary securities, okay? Now some will say, oh well, currency is not really security, it's a whole different subject. It is. It is simply a security. And of course financial claims, these three. Investments, these three plus these two. Okay? Is that fairly clear so far? Okay, let's see what else we got in chapter 5. Okay, well, you have direct transfer of money and securities. We simply call this direct finance. Direct finance is exactly what it says. That's on page 123 in the middle of the paragraph. It is number 1, direct transfer of money and securities. This piece, money and securities, in finance we have a special word. It's called funds. Funds. So it is a direct transfer of funds from those with surplus of funds, we call them savers, to those with deficiency of funds. So from those who have more to those who don't have enough. Okay? That's direct finance. That's extremely rare. It may be direct finance, maybe I'm making a loan to my dad, or back in the old days when I was a student, my dad making me a loan, okay? So there's no intermediary. So now we have the other one which is called, and let me write it in red here. I'll also change these. It's a little easier for me. More important in finance today is called indirect finance. And again, the other one is direct finance is transfer of funds without intermediary. Indirect finance is transfer of funds with financial intermediary, with the help of a financial intermediary. And now comes another clarifying point. Financial intermediary is exactly the same as financial institution. Financial intermediary is just another name for financial institution. That's it. Financial intermediary is the same as financial institution. So, for the next 3 or 4 lectures, we'll be discussing respectively markets, then institutions, and instruments, maybe not in this particular order. Okay. One very special type of financial institution is called investment bank. And investment bank specializes in the issuance of securities, the issues of investment instruments, okay? And whenever in a transaction a security is issued for the first time, it's called primary market. So, primary market is, again, financial market where securities are issued for the first time in order to raise funds. That's called primary market, okay? So, the institution specializing on the primary market is called investment bank. It therefore is a financial intermediary that specializes in the, we say now, issuance of securities, okay? And the other one is called brokerage. And brokerage specializes on the secondary market. Secondary market. And again, secondary market is a market where, we say financial market, where securities are traded between investors. So let's write this out now for your understanding. In a primary market, the seller is always issuer. Issuer is the seller, always. He sells security, and the buyer of security is called bondholder only if he purchased a bond. Stockholder only if he purchased a stock. Alright? We just call him investor. Remember, investment is the purchase of an asset, of a financial or real asset. So, yeah, investor. So, the issuer gives a security to the investor, and the investor provides the issuer with, yeah, money. Correct. We like to call it funds. So, there's an exchange between the insurer. So, the insurer, we say in this particular case, is, here's the key word in English, raising funds. And the phrase is to raise funds, okay? And on the secondary market, the trade is simple. Investor buy and sell to investor, and it's an already existing security. So, security when sold for the first time is on the primary market, always by the issuer. When it's sold for the second, third, and millionth time, it's always by some other investor. And that's primary and secondary. And the broker is associated with helping investors buy and sell securities. That's broker. Broker is, now we say correctly, financial intermediary or financial institution which specializes on the secondary market. Okay, let's see what else we have. Okay. Okay. Now we move and we say depending on the asset type. Depending on the asset type, all assets are divided into two categories. Real assets and financial asset, okay? So all assets are divided into real and financial, every single asset. And you have respectively markets for real assets like gold, oil, and you have markets for bonds, stocks, currencies, etc. That's it. The second category is timing. All financial markets are divided either into spot market or futures market. In a spot market, transaction occurs during the contract. We make the deal, we make the transaction immediately. Okay? In futures, is we make a contract today for a transaction in the future. So 3-month futures would simply mean that we make a deal today that after 3 months I'll buy a stock, or after 3 months I'll just buy a bond, or after 3 months I'll buy a currency. For example, will be, for example, Taiwanese corporation like Acer selling abroad laptops, computers to the United States, and the manufacturer here will get from the United States a payment in dollars. And they will expect from the importer in the United States to get the payment in 3 months in dollars. So they will contract today at today's exchange rate or close to today's exchange rate to convert those dollars, meaning US dollars to Taiwanese dollars, in 3 months, because he wants to lock in the price today for 3 months, and after 3 months, when he gets his US dollars, he'll convert them to Taiwanese dollars. So that will be a futures market. So you have a futures market where contract is today, but the actual exchange, the actual transaction of stock, bond, currency is sometime in the future. On the spot market, you make the deal today, you pay and take delivery today. All right? So you buy the bond today, you buy the currency today. Okay? The simplest example is you exchange the currency. Hey, I want 1 million US dollars, and they say, oh, it's going to cost you 30,000 Taiwanese dollars. And they say, okay, 30,000 you pay, they give you immediately 1,000 US or 1 million, whatever the number is. Okay, so that's group category 2. The third major category is by maturity. And maturity is divided in general in financial economics into short-term and long-term. And markets for short-term instruments we call money markets. Money markets. So, they fall into money markets and money market instruments and capital markets. Capital. So, these are all, let me write it out here for clarity. These are all markets, types of markets. Types of markets. So, financial market is either real or financial, or for real assets or financial assets, is either spot or futures, is either for short-term instruments or long-term instruments, is either, again, on funding, is either primary, which is this primary market, okay? Primary, where the seller is an issuer, or secondary. So according to funding, in other words, we can put in here, according to seller, whether the seller is the issuer or the seller is the investor, okay? And the next type of market is according to, let's call them private markets and public. Public. And the difference between private and public is the buyer. Public means anybody can be the buyer. Public means anyone with money can buy, no problem. As long as you got the cash, we'll call it money, you can participate. Private means not everybody with money. You need to have the connections, maybe you need to have the permission. In other words, not every investor is allowed to buy everything. Some investments are restricted to what we call private investors. So these are investors that are allowed on all sorts of investments. Usually the public is not allowed on all sorts of investment. That's a completely different subject of investment banking is where it's studied. But basically, public market is anyone can participate and anyone who has this, the asset can sell it, and anyone who has money can go and buy. Private is restricted only, we call these qualified investors. So according to seller, the buyer is investor. And here private means only for qualified investors. Okay. And that pretty much gives you the section and the overall stuff. Is it time to go to finish for today? Yeah? Okay, we're finished. Next time we continue.